Following the Ethereum merge, there's been a lot of talk about ETH centralization, and it's led a lot of people to ask the question, was the transition from proof of work to proof of stake worth it, given the clear trade-offs? In today's show, I'm going to be looking at exactly what went down on the Ethereum network after it transitioned to proof of stake, and look at Ethereum's future to see if maybe there was mistakes made along the path to the merge. Let's get straight into the show, because some of the data I'm going to be revealing in today's show is quite shocking. And honestly, in my research for this show, I was left with a pretty uneasy feeling in my stomach surrounding some of the practices happening on the Ethereum network right now. But I'm going to be very objective in today's video, break down all the data, and then at the end, give you my take on what I actually think this means for the Ethereum network, and give you guys like a level-headed take on the situation based on the research that I have done. So the first thing to note is that the merge was successful. So in the lead up to the merge, that was the big question. Was it going to be a success? And it was. We had that finalized checkpoint go through. No clear issues with the merge itself. So that was one box ticked with the merge. Obviously, the market did drop post-merge. That's partly because the funding rates were so high. The leverage ratio started to creep up on Ethereum. That did result in an Ethereum drop and, a generalized altcoin sell-off across the market. But also, what I think mainly drove that sell-off was, macro-related events. We have FOMC tomorrow. A lot of people are kind of de-risking in the lead up to that. Then we obviously did have that CPI come in slightly higher than expected. That meant the likelihood of a 100 BPS hike is now slightly higher. So the market is just slightly more risk-off than it was last week. And it was unfortunate that on the day of the ETH merge, we did get that macro news, which did result in the sell-off. And obviously, buy the rumor, sell the news has to be factored into some extent there, as people got a little bit greedy in the lead up to the ETH merge. But I do think it was mostly macro related, although crypto is obviously selling off a little bit more than equities right now. So with the Ethereum merge officially going live, I think, that did a few things to the network. The first thing it does is it does increase transaction speeds. We know proof of stake is objectively faster to process transactions and blocks than proof of work, as the difficulty is easier for validators to process on transactions on proof of stake. Gas fees weren't impacted by the merge. That is something that can definitely happen in the future as the merge points Ethereum on that path to scalability. So this is something that we'll see come to fruition once ZK rollups, etc. are implemented. The third thing is staking. And this is probably the biggest one. Now people can actually, stake their Ethereum and earn yield on their Ethereum around 5%. But obviously with your staked ETH, you won't be able to technically withdraw it for 6 months after the merge as we wait for that major staking upgrade to take place. So a few major changes because of the merge. I think overall, what it does in and of itself is kind of point Ethereum in the right direction with these future upgrades. But I think the question now becomes, was it the right direction? Well, the first part of answering that question is the deflationary aspect. So a lot of the hype around the merge was Ethereum becoming a deflationary asset as the issuance of the Ethereum token was decreased. Interestingly, despite a reduction in ETH issuance over the first 2 hours post-merge, we actually did see an increase in issuance. In fact, the issuance has been increasing steadily. Now we've seen an increase of 3,173 ETH since the merge, which means 3,000 ETH have essentially come onto the market since the merge. So it technically is not a deflationary asset yet, as the current fees and network usage are not conducive to deflation, are not conducive to deflation quite yet. However, if we do simulate this scenario, if we simulate the supply chain based on the proof of work network, then the Ethereum supply chain becomes a couple 100,000 ETH. So even though Ethereum is still inflationary, it is much less inflationary than it would have been if the merge never took place. So the supply chain is 3,000 on proof of stake. If we were still on proof of work, the supply chain will be closer to 200,000 ETH. So technically, although it's not deflationary yet, it is still better. It's the better of two evils from an issuance perspective. But technically, all that deflationary ETH stuff that you heard being talked about into the merge, technically it was false for now, because that did rely on future models. And could ETH become deflationary one day? Yes, but right now it isn't. And that certainly has, I think, contributed to some of the FUD we're seeing around Ether. All right, the next thing we have to talk about is the decline in ETH BTC. We did see that sell-off, of course, partly macro-related, but the funding rates were getting pretty high. The merge did result in that major sell-off, and we saw the biggest decline in ETH BTC since May 2021. Now, pre-merge, we actually did say that I did expect capital inflow into Bitcoin to increase versus Ethereum. Ethereum did lead that altcoin rally, but it does make sense for Bitcoin to gain a little bit of steam on Ethereum post-merge, as some of the investors kind of have to rotate capital. If you're taking profits from the merge, unless you're taking it into stable coins, it does make a lot of sense to take profits into Bitcoin and some of these other L1s. Part of the reason why, despite Bitcoin and Ethereum dropping, some of the other altcoins are actually holding up okay, and that dominance hasn't really gone up that much, because people need somewhere to rotate capital. That's why the ETH BTC pair did see that huge decline, a general capital rotation into Bitcoin, as Bitcoin becomes one of those major beneficiaries. So now I want to talk about the transition to proof of stake and what the advantages and disadvantages are. And then we're going to get into the centralization discussion, which is very important, because that essentially is going to verify how decentralized or centralized the Ethereum network is. Because there is actually some shocking data that I uncovered about ETH centralization, that a few people on Twitter have started to talk about, but it just shocked me when I actually dug into this data. So just before we get into that, remember, if you want to do any trading, buy, sell any altcoins, then you can do so on ByBit. You get the $4,200 sign-up bonus if you sign up. I know most of you already signed up, but I'm just giving the option there for the people that haven't taken advantage of this crazy sign-up bonus while you still can. So link in the description to that if you want to trade any cryptocurrency. So I guess to verify ETH's relative centralization, we have to look into the benefits and the negatives of proof of stake versus proof of work. So proof of stake, I'll just outlay the benefits really quick. Firstly, obviously, transaction speed. So with proof of work, Ethereum was never going to become that next internet iteration, that we want Ethereum to become. We essentially, want Ethereum to be kind of like the next internet, I guess, in a Web3 sense. So for it to do that, it needs to onboard a mass amount of users. So it needs to scale. Now, proof of work, it can't really scale. And when it does, it's very energy intensive. And even then, the gas fees are going to be extremely high, as proof of work still isn't a very scalable consensus mechanism. So basically, the only way Ethereum becomes that next internet of sorts, which is clearly what the Ethereum Foundation is trying to push, then it does need to switch to proof of stake. Right now, that's the only viable option. But I guess there is a genuine argument that staying on proof of work kind of makes Ethereum that main banking transaction layer. So the transaction layer for big transfers, because it's more secure. You could transfer more money. It's used by institutions primarily, kind of like Bitcoin's being used, but just like a slightly beefed up Bitcoin from a transactional standpoint. That is kind of the argument for proof of work, but that's not what the Ethereum Foundation wanted. And we know it's not what they wanted, because since 2017, they've been on this path to proof of stake. So it kind of surprises me that a lot of people on social media are now talking about the negatives of proof of stake, because we've known this has been coming for 5 years. Like, we have known for a long, long time proof of stake was happening. I guess we just didn't have clarity on when. And now that it's happened, it's become very, very real. And the risks are now right in front of our eyes. Whereas before, it was still kind of up in the air to some extent, even though it was inevitable. We didn't know exactly when it was happening. Now it's happened, and we can see the clear risks in front of us. These are a few of the risks of proof of stake. You've got security issues. It is objectively less secure. Adam Back's done a lot of research into this as kind of one of the pioneers of proof of work. He does state that the security issues are immense on proof of stake compared to proof of work. It's just a less secure network, and it's objectively more centralized because essentially smaller nodes can be overpowered by larger ones. So on proof of stake, whoever holds the most tokens are rewarded, versus mining power. There is a clear barrier to entry with mining power. So if you want to become a miner, you have to own a lot of equipment. You have to invest a lot of capital. That also means that it's a lot harder to dump. Because if you want to dump your Bitcoin or Ethereum and you have all this mining gear, well, imagine trying to sell that mining gear on the market. Like, that's not a very easy process if it's achievable at all, and it doesn't make sense to do so in a lot of cases. So there's less incentive to dump. There's more of a barrier to entry, more of a barrier to exit as well. Whereas proof of stake, it's just the stakers that are validating the network. They can unstake and dump their tokens at any time. So I guess that is one of the issues. It's that added liquidity. And it's also the lack of decentralization, because larger nodes can easily control the delegate nodes, makes it more difficult for smaller nodes to participate in consensus, as the people that hold the more tokens have more power over the network. So that's the next negative. And then you've got poor scalability. Proof of stake, I would disagree, because although proof of stake in and of itself can have poor scalability, we know that it can, or it does have a path to scalability through like your ZK rollups, through your sidechain. chains through your L2 solutions. It definitely can become scalable. I guess, though, we haven't really seen an L1 iteration that has great scalability yet, because you'd argue like a Solana does. I mean, that's technically proof of history, not proof of stake. I mean, it's kind of, very similar comparison, but proof of history. Technically, a few of these chains do. Like, you could argue Solana does. You could argue like a Phantom does, being EVN. But technically, I mean, it's still very limited in its scalability when we compare it to traditional finance. When we compare it to your Visas, your PayPals, they can still process significantly less. In most cases, in a real environment, not in a test environment. So I guess proof's still in the pudding with the scalability aspect of the trilemma, and then inefficient use of resources. So look, there's a few negatives here, a few disadvantages, but I'm focusing on point 2 because this is the big one, and this is the scary one for Ethereum. And this is the one that's become very, very, very apparent over the recent days as Ethereum has officially switched to proof of stake. This data shocked me. And this was that 70% of ETH nodes are running on Amazon and 4 other cloud service providers. So a lot of the validators for Ethereum actually run on web services. Now, what's web services? Web services is a way for any company to gain computing power. So Amazon essentially has a server of computers, like a massive warehouse of GPUs, and you can essentially rent these GPUs or outsource them using Amazon to get computing power. And over 53% of ETH nodes are actually running on Amazon. So if you want to start a validator node, you can set up a validator in your own house, but you're using a lot of electricity, and there's a barrier to entry there because you've got the cost of computing, you've got the upkeep, and also you've got the maintenance of that computer. Whereas Amazon, you can pay them, they take care of it all for you. Obviously, you pay a subscription fee, but that is outweighed by the staking rewards if you have enough Ethereum to outweigh it. So a lot of people outsource to Amazon. This does create a centralization concern. Although every node is on a separate computer, you still have one entity controlling all those computers. So it probably won't happen, but theoretically, there's a tiny percent chance, and Amazon could technically just shut off the entire network, or the government could sanction Amazon to shut down all the nodes, or something funky could happen inside Amazon, and that creates systemic risk. Now, I'm not saying that'll happen. I'm not trying to FUD. I'm just saying there's always an added element of risk when you have a significant amount of nodes being controlled by one server. And we will get into whether this is actually a good or a bad thing, because I don't think it's as linear as what I might be putting front right now, but I just want to kind of get the data out of the way and then dissect the good and the bad afterwards. The next thing that is kind of shocking is Flashbots. Now, what Flashbots are essentially building blocks for the Ethereum mining data. So a single server for the Ethereum building blocks following the transition from proof of work to proof of stake has actually been on Flashbots. So it's a centralized entity. It has efficient maximal extractable value extraction, very complicated term, which essentially means it delivers Ethereum blocks. That's all you need to know. It's one of the servers processing Ethereum's blocks. So if we look through the block processes and we look at the relay processes, we can see that Flashbots actually accounts for 82.77% of Ethereum's total number of blocks. So this is a very heavy reliance on one singular entity. And this just contributes to the centralization. So we know we've got the centralization with AWS nodes. Now we have the centralization with the relay blocks. And 82% is a lot for a singular entity. So that was also, quite a shocking statistic. Some of this we did know before proof of stake. And we knew this was happening, but it's kind of just become more apparent now that we actually have had the merge take place. Then we look at the staking side of things. Now, on the staking side of things, this essentially means what entities control the percentage of the ETH stake. If we look at the top 7 entities controlling the stake, you've got Lido, Coinbase, and Kraken almost making up 50% of the stake here. So if we go onto the ETH dashboard on June Analytics, Lido's 32%, Coinbase is 14%, and Kraken is 8%. So that is 54% worth of the ETH stake controlled by 3 entities. Now, I think that does introduce an element of risk here, because essentially a Coinbase and a Lido could halt Ethereum together. Like, they have enough control over the total amount of staked Ethereum to halt the network. Technically. It'll never happen, but technically. Add Kraken, and the 3 effectively control ETH's governance. So this is the worrying part that a lot of people have been talking about, and that's the fact that because now we're on proof of stake, miners are no longer validating transactions. Now you have a very small amount of entities validating transactions. I mean, over 50% now owned by 3 entities. Now, the important thing to note, though, and this is one of the major caveats is that Lido technically is not a centralized entity. Lido is a DAO. There's no one person that's controlling these 30% of the tokens. Unlike Coinbase and Kraken, where there is a little more risk, with a Lido, it's the individual user staking ETH. So it would take, and then Lido's simply taking that ETH that they've gotten, that stake from users, and then they're staking it on their behalf. So Lido in and of itself isn't this big, scary, centralized ETH holder, but it certainly is a proxy for staking Ethereum. And that does obviously introduce an element of risk. But Lido is a DAO, so which means it's an autonomous organization, it's decentralized, and it's controlled by LDO holders. However, 50% of LDO holders, so 50% of ownership of the Lido DAO, are owned by 10 wallet addresses. And Lido has 31% of staked ETH securing the chain. So 10 wallets own over half of the Lido DAO. Now, although technically that's decentralized because, decentralization is a spectrum, when we look at kind of like the logical comparisons here on the market between Lido and other DAOs, that's a pretty centralized DAO to me. 50% of tokens being held by 10 addresses is relatively centralized. That, I would say, is slightly worrying from Lido's perspective. But this is a common theme across crypto. This isn't ETH specific, because decentralization is in many ways a myth right now, and I'll get into that in just a minute, because I do have an opinion on this, a strong opinion. But there's one more thing I want to show you, and that is the Nakamoto coefficient. What the Nakamoto coefficient is the measurement of decentralization. So this is essentially a coefficient which uses a few variables to determine how centralized a protocol is, and it weighs it against other protocols on the market. Now, looking at Ethereum, it has a Nakamoto coefficient of 2. The lower the coefficient, the worse. The higher, the better in terms of decentralization. Ethereum has a score of 2. For perspective, Solana has a score of 30. Solana is now objectively more decentralized than Ethereum. Now, that's crazy to me because we've heard the concerns around Solana for months. That Solana's centralized, like don't invest in Solana, it's centralized, blah, blah, blah. Ethereum is now more centralized than Solana. Like, that's crazy. It's absolutely crazy. So the merge has created a little bit of damage here, in my opinion. We knew this was going to happen, though, but it's created damage to the narrative. I think that's above and beyond what we knew. What we know now is that is damaging the narrative. And we can see this because there's a lot of talk about it, including me right now, because it is a genuine concern. And it's one of the issues with Ethereum. Now, will this get better? Absolutely. Absolutely, it'll get better over time. 100%. This is mostly, and that's also factoring in whether you view Lido as a centralized entity, which is not, it's a DAO. But it does create concerns. Now, the Ethereum staking is also, I think, what did contribute to the drop that we saw in Ethereum post-merge. And that's because although the SEC for quite some time has said that they didn't see ETH as a security and they saw it as a commodity, once the ETH merge occurred, they came out straight away. They saw this as an opportunistic and irrelevant time to announce that they were going to consider Ethereum as triggering security laws. So Gensler said from a coin perspective, that's another indicator under the Howey test that the investing public is anticipating profits based on the efforts of others, indicating that ETH could be subject to security laws. Just another bit of FUD that came out afterwards. Now, all right, let's actually get into my take on all this stuff, because you've heard all about the ETH decentralization, but the question is, does it matter? Does decentralization even matter at this point? So I'm still a little bit sick, but I'm powering on. So here's the thing. By switching from proof of work to proof of stake, there was a clear trade-off. So they essentially traded decentralization and security for speed and scalability, because that's what proof of stake offers. Now, there's nothing inherently wrong with this trade-off. It just depends on what you value more. A lot of people want to participate in the crypto economy because of the inherent benefits that decentralization offers. If you value that, you will not like these changes to Ethereum. And I would say some large investors will definitely be swayed by some of the centralization data that we have gotten post-merge. But there's nothing wrong with this trade-off, because if Ethereum does want to become that next internet of sorts, it wouldn't have been possible on proof of work. So that really then becomes a fundamental argument of what Ethereum's goal is. Now, the foundation dictates what Ethereum's goal is. And we know they want to become the next internet. And, you know, if that's really the path to mass user adoption, then technically long-term, the merge is a bullish thing, irrespective of the centralization. However, there is a strong argument for ETH to be used as that transaction layer for big transactions, bank payment processing, institutional processes, which would kind of shift its use case from this kind of internet for retail to an internet for banks. Now, I personally think long-term, the merge is still a net positive, all right? So I think out of the two options, proof of stake versus proof of work, if we look at both of them and take all of the advantages and the disadvantages, I still think the merge is a net positive. But it might not be as resounding as people would like to think. The argument for it being a net positive is that decentralization is largely misunderstood. I said this in a tweet. I think many people value decentralization as this overarching indicator of whether a coin has good fundamentals or not. It isn't. Because crypto's still at that stage, guys, where centralization's needed. Now, this might sound crazy, but just think about it. If you're launching a project, launching fully decentralized straight away is not feasible. It's not financially feasible. It doesn't do the greatest job for network growth. It's much harder to adapt and evolve the network if there's issues. Having a centralized network in the beginning makes it far more adaptable. It makes it easier to get VCs in on the network. It makes it easier to work towards that final goal. And that final goal obviously is user growth, but it's also decentralization. So I think what we are in the situation of right now in crypto is we're under the pursuit of decentralization. We aren't at the stage where we are at the point of decentralization. Projects are simply launching with the end goal of becoming decentralized. And I think centralization in the meantime is needed along the way. I think it's unfeasible for a project to launch fully decentralized. Did Bitcoin do it? Technically, yes, in many ways it did. But you know, we're not comparing Ethereum to Bitcoin here. Bitcoin is a totally different project in its own right. We know Bitcoin can't handle mass transactions. We know it's basically useless as a payment layer. I mean, Lightning Network, that's a completely different argument. But the argument for Bitcoin is store of value, and maybe in the future an inflation hedge. It isn't right now, clearly, but maybe in the future. So that's the argument for Bitcoin. Ethereum, completely different target market. So when people are comparing the two, maybe if you're an institution and you really value decentralization, it makes sense to make that comparison. But ETH is a bet on adoption and network effect, right? So if to achieve that, you do need some centralization in the beginning. So decentralization, we are currently still in the stage of crypto where we're pursuing decentralization. And it's okay in the meantime to be slightly centralized. And I think that's one of the major things that people are overlooking, when they're discussing Ethereum at the moment. It's okay. Now, does it introduce a risk? Fuck yeah, it does. It introduces a lot of risk. And it certainly makes me slightly less... Actually, no, it doesn't make me less confident in Ethereum. All it does is affirm my thesis. And what is my thesis? That the future is almost definitely multi-planetary or multi-chain. There are going to be multiple chains. Ethereum, obviously being the network where most of the development's happening, most users are familiar with, I think that'll always be around. And I still think there's a massive use case for Ethereum. But does the chance of another L1 flipping Ethereum increase? I actually think it does now. Because some of these other projects have that benefit of launching with a better tech stack, which means they can evolve much quicker, even though Ethereum has more development. So I think having those hedges in those other L1 ecosystems makes a lot of sense. And having Ethereum sitting as 40, 50% of your portfolio like it previously would, look, it really depends on you. I'm not a financial advisor, but for me, that's rash. That's a little too heavy in the weighting. I definitely think some of these other L1s become the better risk reward play now. I genuinely do, because it's not as simple as just saying, Ethereum's the biggest, it's the safest, it'll 10x, like it's 177 and it'll get to $1 billion. It's not that simple, because the good investments aren't based on market cap. The good investments are based on EV, or expected value. And that factors in the risk reward profile of an investment. So if you can get an investment with more upside but less inherent risk, then that's the better play. And I think some of these centralization concerns add inherent risk to the Ethereum network, and Ethereum still doesn't possess the upside that some of these other projects do. So I like Ethereum 100%. And I don't think this necessarily sways my long-term fundamental stance on ETH, but it just makes that extra case for your Solanas, for your near protocols, or some of the other ecosystems you're bullish on. I won't get too much into it today because I'm going to be doing a portfolio video this week where I actually discuss what I'm looking at buying because I think that's very pertinent right now given the market drop. But yeah, I definitely think it makes that case for a strong ETH hedge. Solana and Near become those clear ones, in terms of big caps. But you've got BNB for the exchange play, FTT obviously another bet on Sam as well. Cardano, XRP, I mean, you can invest in them if you want. I'm not the biggest fan for reasons that I've stated in previous videos, but I get the logic. I get it if you have to. And then we go down the list, and there are some amazing protocols, some amazing tech stacks that I'll be digging into over the next few weeks. You've got those privacy layers, A0 and Secret, which are brilliant. Some of the L1s in the Cosmos ecosystem, are looking quite strong as well. That stuff is for a future video, but the point is, there are risks in Ethereum now that probably mean you can afford to diversify a little more into these L1s. And I do believe in this multi-chain thesis. I just think of it like this. This is the simplest analogy I can give you. Just look at the smartphone market, right? You've got Apple, biggest player, right? But then you've got Samsung, slightly smaller, but still has a massive market share. And then you've got a few other big companies. You've got Huawei. You had BlackBerry and Nokia. You don't have them anymore. But you've got those kind of other big companies. You've got Google's phone, which even though the Google phone might not sell nearly as much as the iPhone, it's still selling a lot, right? So comparing that to crypto, it means if Ethereum's the Apple, yeah, it might be worth the most, but there's still significant room for growth in that secondary ecosystem that can push Ethereum, if not overtake it. And then those third ecosystems, which are valued at 1 billion, if Ethereum scales to a few hundred billion, not million, in market cap, then the Google phone only needs to take 5% of that market share to hit 50 billion, right? So, and that's not a huge ask to make in crypto. So, just kind of an interesting comparison there, and one to keep your eye on. It's very unlikely we have a monopoly in crypto. Very likely the future's multiplanetary, which is one of and the reason I make the multiplanetary analogy is because I read it. I forgot his name, but there was an amazing Medium article on this. In fact, I'll see if I can find it right now. Crypto. There's also the one about cities, the very famous one about cities. Multi-city. I'll just look this up right now because it's a great one. It's a great what's the blockchains of cities? By Hasib, of course. By Hasib, one of the major major appearers on Crypto Banter, also works at Dragonfly Cap. Look at this Medium. It's really, really good. So basically the same as that multiplanetary argument, essentially just a different analogy for that is the multi-city argument, blockchains of cities. And this does a good job of kind of describing how multiple chains will live together. And it kind of swayed my thinking a lot. You've got Ethereum as New York. You've got other analogies here, like what's number 3? Solana, Avalanche, Nia. As kind of near San Francisco, he says. So look, there's some good analogies here, but it basically just kind of frames the thinking around the multi-chain future. And I find that stuff very interesting. So definitely check out that article if you want. But yeah, at the end of the day, my TLDR, the very quick summary on the video is, no, it isn't. There's no reason to panic with Ethereum. It just gives us, a reason to maybe adjust our thesis a little bit, and also just be aware of the centralization concerns. Not panicking, but definitely aware of it. Now, I'm going to go live on Instagram now. There's a link in the description to my Instagram. I go live every day. We discuss some trades. We discuss, I answer some questions, do a Q&A after these shows. So if you are available for another 20 minutes, I highly recommend joining me on Insta if you want to ask any questions. We can have a further chat, what I'm buying, that kind of stuff. We'll do an Insta. I also follow some people back. So link in the description to head over to Insta and hang out with me. I do see a few questions here. Someone said, great content. Appreciate it, guys. We'll definitely continue over there now. Awesome. All right. If I don't see you over there, I will see you tomorrow at the same time. Cool. See you later, guys. Peace.